Hello everyone, welcome to the 193rd episode of me learning how to trade in Forex. So in the last episode, we finished off some of the option Greeks. So let's just start off with option delta then. So option delta equals where is it? I think we went through the option delta, but anyways, delta is the rate of change of an option price given a $1 move in the underlying market price. Positive delta equals long market, so benefits if the stock goes up. Negative delta is short market, benefits if the stock goes down. And neutral delta is your neutral market, so 0. Long call options have positive delta as they offer the owner the opportunity to buy the stock at the strike price. If the stock price increases, the option value increases. Long put options have negative delta as they offer the owner the opportunity to sell the stock at a strike price. If the stock price decreases, the option value increases. Short call options have negative delta as they offer the seller the opportunity to buy the stock at a lower price. If the option decreases in value, the short side benefits. Short put options have positive delta as they offer the seller the opportunity to buy the stock at a lower price. If the stock price rises, the short side benefits. So positive deltas range from 0 to 1, negative deltas range from -1 to 0. The lower the probability that the option will expire in the money, the lower the delta value will be. The higher the probability the option will expire in the money, the higher the delta value will be. So the higher the delta, regardless of the positive or negative sign, the more sensitive the option price will be to changes in the stock price. So option delta could be used as the probability of being in the money. So delta can be viewed as a directional risk gauge. If bullish, should have a positive delta. If neutral, should have a near zero delta. If bearish, should have a negative delta. Option delta grows stronger as the option moves in the money and grows weaker as the option moves out the money. So that's for option delta. For option theta, theta is the daily rate of an option's extrinsic value. So short options benefit from the decay of extrinsic value, long options are at risk from the decay of extrinsic value. Theta is a positive value for option sellers as extrinsic value decays in favor of the seller. Theta is a negative value for option buyers as the extrinsic value are decaying against them as expiration nears. So the more the extrinsic value, the higher the theta, the more time until expiration, the lower the theta. Theta decay is bad for option owners but good for option sellers. And when shorting options, having a strong positive delta is a good thing, as it means there's a strong positive decay for the risk taken so that trade can be closed prior to expiration for profits. Extrinsic value and theta are closely related. At the money options will have the highest extrinsic value and the highest theta numbers. Out of the money options have the lower extrinsic value and lower theta numbers. Theta is preferred to be maintained above $1 for most options. If the theta is less than $1, it could mean there's a lot of risk for little potential reward, or the option is worthless with lots of time until expiration. In long spreads, negative theta can be mitigated with the sale of a short option, which also reduces the cost basis. And theta is a non-linear number which accelerates as the option gets closer to expiration. And then opt for option vega. Vega is the rate of change of an option's extrinsic value given a 1% change in the underlying implied volatility. When options are bought, implied volatility increases. When options are sold, implied volatility decreases. When traders are fearful and buying options to speculate or hedge investments, implied volatility tends to spike. When traders are complacent, implied volatility tends to collapse. Vega is positive for option buyers and negative for option sellers. Option owners benefit from an increase in the implied volatility as more traders are buying the option, which increases its price. Option sellers benefit from a decrease in implied volatility as more traders are selling the option, which decreases its price. Vega is lower for options with less time until expiry, as changes in the implied volatility won't affect the price that much. And Vega is higher for options with more time until expiry, as changes in the implied volatility could mean a big change in the option's price. So sell options when the implied volatility and implied volatility rank is high. The higher the implied volatility rank, the more extrinsic value the option has. The closer the stock price, the closer to the stock price, the higher the extrinsic value. theta and vega value will be. So a straddle will have higher extrinsic value, theta and vega values on the strangle, as the options are sold at the money in a straddle and out of the money in a strangle. So that's what we went through in the last episode, and now we're on to opening an options trade. So opening an options trade.
In this section, I'm going to show you how to open trades in the platform, but first let's quickly review some trade entry concepts. Buying an option, spread, or stock is easy to understand. We pay premium in the form of a debit to own the investment, and we can then sell it later to complete the trade. In all situations when we're buying to open, we want to pay a lower amount to open the trade than what we sell it for later. If we can achieve this, the difference will be profit. If I buy an option for $5, it's easy to understand. We pay
buying.
Quickly review some trade entry concepts. Buying an option, spread, or stock is easy to understand. We pay premium.
Buying. So buying to open.
In the form of a debit to
pay premium in the form of a debit to
own the investment, and we can then sell it later to
and sell it later
complete the trade. In all situations, is easy to understand. We pay premium in the form of a debit to own the investment, and we can then sell it later to complete the trade.
Sell it later.
In all situations when we're buying to open, we want to pay a lower amount to open the trade.
Want to pay a lower amount to open a trade
than what we sell it for later.
Than the selling price later on.
If we can achieve this, the difference will be profit.
If achieved, the difference is profit.
If I buy an option for $5 and sell it for $7 later, I would make $2 per share, or $200 in real dollar terms. If I buy 100 shares of stock for $10,000 and sell the shares later for $12,000, I would make $2,000. As you can see, the best case scenario when we buy to open is realized when we can sell to close for a higher price later. The difference in price would result in profit. If we sell to close for a lower price than what we bought it for, we would realize a loss. Like you learned,
if sell to close at a if sell to close at a lower price, a loss is made.
Learned earlier in the course, if we buy an option for $2 and hold it to expiration, if the option is at the money or out of the money, we would realize a full loss of $2 per share, or $200 in real dollar terms. At the end of the day, we want our option or stock that we buy to increase in price so we can sell it for a profit. With stock, this only results from an increase in the stock price. With long options or spreads, it could be a result of an increase in implied volatility or a favorable directional move without too much time passing. At the end of the day, we want our option or stock that we buy to increase in price so we can sell it for a profit. With stock, this only results from
an increase
in the stock price.
An increase in the stock price.
With long options or spreads, it could be a result of or a favorable to increase in price so we can sell it for a profit. With stock, this only results from an increase in the stock price. With long options or spreads, it could be a result of an increase in implied volatility
or spreads. It could be
a result of an increase in implied volatility.
Could be from an increase in the implied volatility.
Be a result of an increase in implied volatility or a favorable directional move without
without
too much time passing. Selling an option, spread, or stock is a little more tricky,
Selling to open.
as you've realized through the course. We collect premium in the form of a credit and
Collect premium in the form of a credit
assume the risk of the position.
to assume the risk of a position.
Premium in the form of a credit and assume the risk of the position.
And assume the risk of the position.
Later, we can buy the trade back
And buy the trade back later.
to complete the transaction. In all situations where we are spread or stock is a little more tricky, as you've realized through the course. We collect premium in the form of a credit and assume the risk of the position. Later, we can buy the trade back to complete the transaction.
Buy the trade back later, yep.
In all situations where we are selling to open, we want to collect a higher credit on trade entry than the
Want to collect the higher credit on trade opening
debit we pay to close the trade later. If we can, in all situations where we are selling to open, we want to collect a higher credit on trade entry than the debit we pay to close
the trade.
the trade later. If we can achieve this, the difference will be profit.
If achieved, the difference is profit.
If I sell an option for $5 and buy it back later for $1, I would make $4 per share, or $400 in real dollar terms. If I short 100 shares of stock for $10,000 and buy them back later for $9,000, I would make $1,000. In most premium selling strategies, the best case scenario when we sell to open is realized when we can buy to close for a lower price later. Just like buying to open, trades can go against us here as well. If we buy to close for a higher price than
At a higher price, a loss is made.
than we sold the option or stock for initially, we would realize a loss. The difference between buying to open and selling to open in the options world is what happens when an option expires worthless. When someone buys an option and it expires worthless, that is the worst case scenario. Here as well. If we buy to close for a higher price than we sold the option or stock for initially, we would realize a loss. The difference between buying to open and selling to open in the options world is what happens when an option
The difference between buying and selling an option is what happens when an option expires worthless.
worthless. When someone buys an option and
When buying an option
it expires worthless,
and it expires worthless,
that is the worst case scenario.
it's the worst case scenario.
When someone sells an option and
When selling an option and it expires worthless,
it expires worthless, that is the best case scenario.
it's the best case scenario.
At the end of the day, we want our option or stock that we sell to decrease in premium value so we can buy it back for a profit. With stock, this only results from a decrease in the stock's price. With short options or spreads, it could be a result of a decrease in implied volatility. We want when an option expires worthless.
So this
When
is
someone buys an option and it expires worthless, That is the worst case scenario. When someone sells an option and it expires worthless, that is the best case scenario. At the end of the day, we want our option or stock that we sell to decrease in premium value so we can buy it back for a profit. With stock, this only
results from a decrease in the stock price.
Results from a decrease in the stock's price. With short options
with short options or spreads,
it could be a result of a decrease in implied volatility
from a decrease in the implied volatility,
a favorable directional move, or
a favorable directional move,
time passing. Remember, time passing or theta decay is an asset for short option sellers and a liability for long option buyers. Obtaining a high credit when selling premium helps us widen our break-evens, benefit from a contraction in IV, and have a high theta number, and a liability for long option buyers. Obtaining a high credit when selling premium
helps
us widen our break-evens,
helps widen break-even points,
benefit from a contraction in IV,
benefit from a contraction in the implied volatility,
and have a high theta number. This is why we prefer to sell premium in high implied volatility and IV rank environments and get more conservative in low IV and IV rank environments. This is why we prefer to sell
premium in
high implied volatility
and
IV rank environments
and implied volatility rank environments,
and get more conservative,
be more conservative in
low
implied volatility and implied volatility rank environments.
And IV rank environments. Regardless of the environment, we stick to the 45 day till expiration window for expiration cycles because we want to take advantage of increasing theta numbers that tend to accelerate around that time.
45 days till expiry.
In low IV and IV rank environments. Regardless of the environment, we stick to the 45 day till expiration.
Stick to the 45 days till expiry
window for expiration cycles because we want to take advantage of increasing theta numbers
to take advantage of increasing theta numbers
that tend to accelerate around that time.
Which tend to accelerate around that time.
This time frame also gives us ample time to be right if the trade goes against us quickly. This is especially true for debit trades, which can decay against us every day. Regardless of the strategy, we ensure that our risk and position size is in line with our risk tolerance and our directional risk is not too far from where we want it to be. Come take a journey with me into the Tastyworks platform and let's take a look at how these trades look in real time. Welcome to the Tasty Trade platform, where we can easily place, adjust, and close trades. You can see my watch list along the left side where I can see what's going on with stocks I'm interested in. Along the top, you can see that I've typed in CAT, which is Caterpillar's stock symbol. The stock details are
Caterpillar stock symbol, right, okay.
listed to the right. It has an IV rank of 81.4, meaning the current IV percentage.
Oh, Caterpillar as in like the actual company Caterpillar. Oh, right. I thought it was like some special tool.
It has an IV rank of 81 along the top. Welcome to the Tasty Trade platform, where we can easily place, adjust, and close trades. You can see my watch list along the left side, where I can see what's going on with stocks I'm interested in. Along the top, you can see that I've typed in CAT, which is Caterpillar's stock symbol.
Oh, Caterpillar. Oh, right, okay. Yeah.
The stock details
As
are
in, like,
listed to
the construction company Caterpillar.
the right. It has an IV rank of 81.4, meaning the current IV percentage is on the higher end of the range CAT has seen over the past year, just like you learned earlier in the course. The stock price.
So high IV ranking means sell premium.
Price is currently around 130, and it is down 47 cents today. 5 million shares have traded today, so you know it's a very popular and liquid stock. Right now we're on the trade tab, looking at the curve view, which will be very similar to the visual strategies you've seen in the course. I want to take advantage of the high IV CAT has with earnings coming up, so I decide to sell a strangle. Using the strategy menu, I can quickly load a strangle by clicking on the drop-down menu and selecting short strangle. As you can see, there are plenty of other strategies listed here too. I can click on short to switch to long, and vice versa.
Well, short put vertical, short put strangle, short put straddle, short put option, short put iron condor, short call covered, short put butterfly, short put jade lizard, short put calendar, long stock. Damn.
Versa. I select short strangle, and it spits out some strikes that I can easily adjust. I'm in the November cycle already, which is actually where I want to be. I think CAT will stay within a 20-point range for earnings, so I sell a 120 put and a 140 call to strangle the stock price. There's $3.44 of extrinsic value in this trade, which is what I'd sell it for. This is my max profit on the trade, and realized if the options expire worthless. The delta is pretty neutral at -6, as both the short put and short call offset each other, and I have a nice positive theta of $15 per day. That means if the stock price stays the same and there's no change in IV, this spread will decrease or decay by $15 per day. If I click on the Analysis tab in the upper left corner, the platform will show me the actual risk graph for the trade. I can zoom in and zoom out to scale the strategy to my screen, and I can analyze from there. You can see my upside break-even is 143.44, and my downside break-even is 116.56. Just like you learned earlier, my 344 credit boosts my break-even past my short strikes, as the credit benefits me and can be used as a buffer against my losses. The probability of profit on this trade is nice and high at 74% because I'm covering such a wide range for the stock to move. Everything looks good to me, so I'll go ahead and click review and send for one last peek at the trade. This trade will reduce my buying power by $1,700, which is pretty typical for a naked option strategy on a $130 stock. If I'm filled at $3.44, that would result in a 20% potential return on capital if the trade expires worthless and fully profitable. I'm just dividing my max profit by the capital I have to put up to place the trade, which gives me about a 20% potential return on capital. Pretty good for a 25-day trade. Everything is good to go, so I click Send Order to route the order to the market for a fill. Going back to my Positions tab, I can see that the trade is now working at $3.44, and the market price is right around there. If I want to cancel the order, I can right-click on it and select Cancel. I can also change the price of my order by selecting Replace Order if the price drops, or if I'm not getting filled at my current price. That's it! Now you know how to place a trade on the platform using the curve view, which is nice and visual and very similar to the lessons in this course.
Oh my.
Let's review. In the option and stock world, we can open a trade by either buying or selling something. If we buy to open, we pay a debit and we hope it increases in value. If we sell to open, we collect a credit and we hope it decreases in value.
In most cases, when we are buying to open, the max potential loss is limited because we now own something and have no additional risk. In most cases, when we are buying to open, the max potential loss is limited because we now own something and have no additional risk. In most cases, when we are selling to open, the max potential loss is unlimited because we are selling something we don't own, selling something we don't own, and we assume the risk of that option, and we assume the risk of that option, or stock increasing in value, or stock increasing in value, and we assume the risk of that option or stock increasing in value. Theta decay works against option owners and for option sellers. Theta decay works for option sellers and against option owners.
When buying an option, spread, or stock, our risk is typically defined at the debit paid. When selling an option or stock, our risk is typically undefined as we're collecting premium to assume the risk, which could be undefined. Theta decay works against option owners and for option sellers, which is why we typically sell premium. Even if we're buying an option or stock, we're selling an option against it to reduce our cost basis and help mitigate this negative decay. In the next section, you'll learn about closing trades and the reasons we may do so. Feel free to read more.
Nice. On to the next one, closing and options trade. Closing and options trade.
Understanding when to close a trade can be tough, especially when we see that we're making money on it. In this section, we'll review the transaction that takes place. Let's talk about selling to close first. If we're selling a trade to close, we must have bought it
Selling to close.
to open in the first place. This is just the conclusion of a stock or options trade that we entered at some point for a debit. Because we're selling to close, we're collecting a credit, and if the sales
Collecting a credit.
price is higher than what we purchased the trade for initially, we'd see a profit.
If sale price higher than initial payment, a profit is made.
The most important thing to remember here is that when we're closing an option contract, we have to sell the exact same strike and expiration to close the trade. If I buy a is that when we're closing an
closing an options contract,
we have to sell the exact same strike and expiration
as the contract
to close the trade. If I buy a 50 strike put in the December cycle and sell a 50 strike put in the January cycle later, that does not close my 50 strike put in December. That contract would still be open because the expirations are different, and I'd be long a put in December and short a put in January. Now let's review buying to close, which is just the closing transaction for something we sold to open. When we buy to
buying to close,
we pay a debit.
Paying a debit.
Just like selling to close, when we buy to close, we must have sold something in the first place. If the debit we pay to close the trade
If the debit paid paid to close the trade is lower than initial payment
is less than what we collected initially, we would realize a profit.
Not initial, you don't pay anything. If lower than the initial credit collected.
Something in the first place. If the debit we pay to close the trade is less than what we collected initially,
is lower than the initial credit collected,
we would realize a profit.
A profit is made.
Just like buying to close, we need to ensure we're buying back the same strike and expiration contract that we sold.
When closing an options contract, have to buy back the exact same strike price, same strike and expiration.
If we don't, the broker will recognize this as two separate transactions and not the closing order for the previous transaction.
Wait a second.
We would realize a profit. Just like buying to close, we need to ensure we're buying back the same strike and expiration contract that we sold.
Yep.
If we don't, the broker will recognize this as two separate transactions and not the closing order for the previous transaction. At Tasty Live, we tend to close trades in a few different scenarios. If our directional assumption on the underlying has changed, if we don't, the broker will recognize this transaction.
Close trades in the following scenarios. Or can close trades in the following scenarios.
If our directional assumption on the underlying has changed,
if the directional assumption on the underlying has changed,
if we decide we want to cut our losses,
if wanting to cut losses,
or if we've reached our profit target percentage.
If profit target percentage has been reached.
The latter is very important to us, and it really boils down to managing risk and reward. Take a look at this example here. Let's say I sold a $9 wide call credit spread for $3. Because I collected $3, my risk is only $6. As you've learned, any credit I collect helps offset my risk. If my profit potential is $3 and my risk is $6, my risk to reward ratio is 2 to 1. Now let's say the stock price drops.
Because you're risking $6. No, you're risking $6 for $3? Yeah, you're risking $6 for $3.
And some time passes, and I see $1 in profit on the trade. If I reevaluate my risk-reward ratio, I can see that it has actually increased to 3.5 to 1. I can now only make $2 more, and I would risk the $1 in profit I see, plus the initial $6. Let's say some more time passes and the stock price keeps dropping. My call spread is losing a ton of value, and now I see $2 in profit. If I can only make $1 more, my risk-reward ratio spikes to 8 to 1. I stand to lose $2 in profit I see, plus the initial $6. It's important to remember that profit we see is not realized until we actually close the trade. With credit strategies that have a defined profit potential, our risk-reward ratio skews against us the more profit we see. For debit trades, this still holds true. The strategies we buy increase in value, which means we now have a more valuable trade that can still expire worthless. This is why we tend to manage or close winning trades at around 50% of our max profit. Helps offset my risk. If my profit potential is $3 and my risk is $6, my risk to reward ratio is 2 to 1. Now let's say the stock price drops and some time passes, and I see $1 in profit on the trade. If I reevaluate my risk-reward ratio, I can see that it has actually increased to 3.5 to 1. I can now only make $2 more, and I would risk the $1 in profit I see, plus the initial $6. Let's say some more time passes and the stock price keeps dropping. My call spread is losing a ton of value, and now I see $2 in profit. If I can only make $1 more, my risk-reward ratio spikes to 8 to 1. I stand to lose $2 in profit I see, plus the initial $6. It's important to remember that profit we see is not realized until we actually close the trade.
Profit seeing is not realized until the trade is closed.
With credit strategies that have a defined profit potential, our risk-reward ratio skews against us.
The risk-reward ratio skews against you
The more profit we see.
the more profit. As more profit is seen.
For debit trades, this still holds true. The strategies we buy increase in value, which means we now have a more valuable trade that can still expire worthless. This is why we tend to manage or close winning trades.
Manage and close winning trades
At around 50% of our
at around 50% of
max profit,
max profit
rather than chase the 100% mark.
rather than chasing the 100%. So don't be greedy, basically, because as you're getting closer to the max profit, the more risk you're taking, because say you reach 99% and then the trade just goes against you completely, you're pretty much risking 98? No, you're basically risking more than say if the winning, say if you close the, no, say if you see the profit around 50%, because you're risking more for a little less. If that makes sense. You're risking more for less, yeah. So the risk to reward is like exponentially increasing.
This allows us to realize the win, redeploy a different trade elsewhere if we want to, and take the risk of having the trade move against us off the table. Let's dive into the Tasty Trade platform and see how this works in real time. Here we are in the Tasty Trade platform, where we can easily place, adjust, and close trades. You can see my watch list along the left side, where I can see what's going on with the stocks I'm interested in.
So same you got, I think this is Netflix.
Along the top, you can see that I've typed in Netflix, and the stock details are listed to the right. It has an IV rank of 54, meaning the current IV percentage is right in the middle of the range for the past year, just like you learned earlier in the course. The stock price is currently around $348, and it's down $16.50 today. 17 million shares have traded today, so you know it's a very popular and liquid stock. Let's take a look at the Positions tab, where I can see all of my positions. A couple of days ago, I sold an Iron Condor in Netflix for earnings. The stock had around a $30 expected move for their quarterly earnings per share announcement, which I thought was very high. I decided to sell an Iron Condor to stay neutral and ultimately bet against Netflix having a huge move after earnings. My assumption
I haven't gone through what Iron Condor is. What is Iron Condor?
was that the stock would not move $30 in either direction, and that it would stay within the range I defined with my short strikes at $295 to the downside and $385 to the upside, a 90-point range, which is pretty big for a $300 stock. I defined my risk here and created a $10 wide Iron Condor because Netflix is expensive and I wasn't comfortable with the risk of something like a strangle, which is the undefined risk alternative to an Iron Condor. Remember, an Iron Condor is nothing more than an out-of-the-money short put spread combined with an out-of-the-money short call spread. I sold a 285-295 put vertical spread and sold a 385-395 call vertical spread at the same time. These spreads offset each other directionally, which is why I have almost a zero delta in this position. My theta is at a solid $6 per day, meaning all else equal, this spread would decay by $6 each day if we froze IV and the stock's price. My short Vega exposure is at -9, which translates to $9 in premium that would come out of this spread for every 1% contraction in IV. Remember, when selling premium, we want the spread to lose value quickly after we sell it. Before earnings, Netflix was trading at $3.39. As you can see, a $9 move is much less than the $30 expected move, which is why this spread has lost so much value. It's currently trading at around $100 less than what I sold it for, which is great for me as the seller. If necessary, I can review the risk of the trade by selecting all the legs and right-clicking on the selection. This will open a new menu where I can close the trade or analyze it visually. You can see that the stock price is right between my strikes, so I'm ready to close the trade. I can do so from the Analyze page by right-clicking on the strike flags or by going back to the Positions tab. Once I select Close Position, the Tastyworks platform will automatically load the closing order for my Iron Condor, which is just the opposite of what I hold. Once I'm on the trade page, I can see the order in the lower left corner, adjust the price as needed, and review the profit I will secure from closing the trade at this price. I decide to close the trade for $2.41. I sold the spread for $3.38, and if I can buy it back for $2.41, that would result in a 97-cent profit, or $97 in real dollar terms. Once I send the order to the market, I can see the working order status on my Positions tab clearly. Because Netflix is so liquid, I should get filled pretty quickly, which brings us back to the concept of a narrow bid-ask spread and the ease of getting in and out of positions. I'm filled after a few seconds, and I've officially secured a 97-cent profit. I can now go back to my Activity tab and review the trade if I'd like by filtering for Netflix trades over the last 14 days. And that's it.
That's it.
Let's review. If we're closing a trade, it's usually because our directional assumption has changed, we're cutting our losses, or we're booking a winner.
Selling to close is rooted for credit and implies that we bought something in the first place. Yep. Buying to close is rooted for a debit and implies we should have sold or shorted something in the first place. Yep.
If I'm selling to close, I must have owned that same exact option, spread, or stock in the first place. If I'm buying to close, I must have sold.
At Tasty Live, we manage most trades at 50% profit to realize the profit and take the risk of the trade going against us off the table.
Or shorted that same exact option, spread, or stock in the first place. When we see a profit on a trade, that also means our risk is higher. Until we close the trade, we stand to lose all the profit we see, plus our initial risk. To battle this, we tend to manage or close our winning trades at 50% profit to take the risk off the table and book the winning trade. In the next section, you'll learn about option assignment and how we can avoid it by rolling the trade. It's crucial that you fully understand opening and closing trade transactions before you get there though, so feel free to watch this video again if you need to, or read more in the written content below.
Okay.
The percentage lose all the profit we see, plus our initial risk. To battle this, we tend to manage or close our winning trades at 50% profit to take the risk off the table and book the winning trade. In the next section, you'll learn about option assignment and how we can avoid.
That's that then. I'm going to leave this episode here then. So, yeah, in the next video, we're going to go through options assignment. So, thank you for watching. Goodbye.